Richard Bernstein is CEO and Chief Investment Officer of Richard Bernstein Advisors, and Ron Insana is a CNBC senior analyst and commentator and co-head of Contrast Capital Partners, and he was the partner of Tom Bergeron yesterday on our stock draft. So let's get that clear. Rich, welcome. Good.
And I'm not a guru, by the way.
You're not a guru. You hate that. I hate that word, guru. But anyway, Rich, you can be a guru, you can be a swami, you can be whatever you want. Why is it not a good thing, in your view, for the market leadership to be as concentrated as it is? I think intuitively we would all understand why, but explain it.
Right. So, Tyler, I think what people forget is that when you're at the beginning of a bull market, you have a broad economic advance that favors a lot of companies. A lot of companies benefit from that. As the cycle matures, effectively you go through a very Darwinistic survival of the fittest. So as the cycle gets older and older and older, and then as it begins to decelerate, we go into narrower and narrower and narrower leadership because fewer and fewer companies can grow. That would be fine if the earnings picture wasn't so bad, but the earnings picture is good. In fact, Credit Suisse pointed out today that value stocks are surprising more and higher than growth stocks, but yet we're seeing this very narrow leadership that suggests to us that this is mostly speculative, not fundamentally based.
How do you react to that, Ron?
No, I don't disagree. The one thing about, whether or not we're at the end of a cycle, it's very difficult for me to assess which cycle we're in. I mean, it seems like we're at the beginning of the cycle when you look at the Fed coming to the end of its, interest rate increases. Yeah. Looks like we're at the middle of a cycle when you look at certain aspects of the economy, and it looks, as Rich said, like we're at the end of the cycle when it comes to other parts. So this is the strangest cycle I've seen in 39 years of doing this, and so I don't know, exactly where we are and what applies. What's interesting, Rich talking about the mega cap stocks leading here. Everybody on our air has been saying that what led us into the downturn wouldn't lead us out of it, and yet the rally that we had was big cap tech. Yeah. Right. So I think it makes it just increasingly difficult to make, again, as I've stated before, any uniform statements about where we are in the cycle and which groups work best at this particular time.
And that's, Rich, why I think it's interesting that, a lot of people are saying, well, look, the market's resilient and it's continually proven the doubters wrong, and you got to be in it, you got to stay in it, and I ask, where do you go then if you're a little bit worried about the concentration of leadership and think that this rally can't last until it broadens out, or that it's not because it's so narrow that it's running on fumes? Where do you turn to?
Right. So Kelly, I'm going to speak in hyperbole for a second. You can basically look at anything else. Because the notion that only these 10 or 15 mega cap stocks are the only companies that are going to grow in the entire world is such an incredibly bearish outlook on the future of capitalism, on the future of economic growth anywhere in the world. I'm speaking a little tongue-in-cheek here, but the menu of opportunities is incredibly broad right now. It's not just those 10 or 15 companies. So if you think about outside the United States, if you think about other sectors in the United States, I would argue there's plenty of places to go. I just don't think, those 10 or 15 companies, the three dominant sectors in the United States, technology, consumer discretionary, communications, they just don't appear very attractive to us. But in terms of the menu, it's actually quite broad right now.
Ron, what do you think?
I don't know. I've always been a little nervous about going overseas, just for a variety of reasons. You look at Eurozone growth today, it was 0.1% for the quarter. China has its ups and downs and is very opaque. And then you look at EM, and a lot of that, if you're a U.S. investor, is wildly dependent on whether or not the dollar goes down.
What the dollar does,
And so, the dollar's come down, and gold has gone up a commensurate amount. So it's one place where you could have made money. And Tom Bergeron talked about that yesterday. We discussed it. But I don't know. Look, I think high quality here is just fine. And we've talked about this before. A 5% 3-month T-bill while you're sitting around waiting is not that bad either. And so I'm not sure whether you you have to cross the pond to get the types of returns that you really want.
Real quickly, Rich, is a last hour, Vahan Janjigian, who shares the view you guys are all talking about, said he was starting to buy small caps because of the underperformance, maybe some value opportunities there. What would you say about that?
So Kelly, I think there's a difference between small caps and smaller caps. If you're ignoring the top 10 or 15, by definition, your portfolio is going to have a smaller cap bias in it. I don't think as we're going into a profits recession, that's the right time to buy small caps per se. But certainly, just avoiding the 10 or 15, you're going to have a small cap bias in your portfolio.
Yeah.
If you look at an interesting chart that Liz Ann Saunders put on Twitter from Schwab today, the Russell 2000 versus the S&P is making a new low.
Wow. So would you be a buyer of the Russell?
That's not my game. But
more of a cautionary,
SMID rather than small if you're going to do it, because I think that maybe the Russell 1000 is more
SMID.
attractive. Yeah.
A smidge of the
Thank you,
smidge.
Guru.
Smidge of the SMID. Yeah. Thank you, Anchor.
Stay classy, San Diego.
I'll be
Bernstein.
yogging right after this.
Yeah,
Yes.
all right, Ron Insana. Thanks, guys.